Hey guys, welcome. Hope everybody's doing well here. Some of you I don't recognize, so I will give you a little bit of my background. My name's Ken Gee. I'm the managing member here at KRI, and I have been in this business for about 25 years. I grew up in Toledo, Ohio. Got my undergrad from the University of Toledo, moved to Cleveland, got married, pursued my master's degree at night at Case Western Reserve University, small private school in Cleveland. And after I received my master's degree, I left and I went to Deloitte, one of the big accounting firms, where I joined their tax practice. Spent 7 years there doing some of the basic compliance work, but more importantly, I got to spend many, many years while I was there doing M&A work, a lot of transaction structure planning, a lot of really, well, if you can call it cool stuff that accountants get to do. It was really exciting, and I certainly apply what I learned there to what I do here every day. It was when I was at Deloitte that really my life changed. So what happened, I was, imagine 25 or so years ago, I was much younger, and my kids were young. My daughter had just been born. And the story goes that it was about 3 o'clock in the morning. I was doing her night feeding, right? I was at Deloitte. It was busy season, the corporate busy season. She was born in September, so I was in the middle of corporate busy season. And it was a really cool time for me, because that was the time I got to spend with just her and I. Everybody else in the house was asleep. Nobody's going to interrupt us, nothing to disturb that time. I really, really liked that time, until one night I started thinking, wait a minute. And something's wrong with this picture. This is 3 o'clock in the morning, and this is my father-daughter time. And that's just that just really, really frustrated me. I continued to think about this whole situation, and I realized, how am I going to put these kids through school? Many of you are probably having that same thought if you have a young family. How am I going to put these kids through school without a lot of debt? How am I going to structure my life so that the 3 o'clock in the morning night feeding is not the quality time that I get with my kids? I did not want to miss my basketball games and football games and whatever it is that they were going to do. I didn't want to miss that. So it was at that time I said, you know what, I need to change this. And so I started this process of trying to figure out multifamily. Back then, there was nothing out there for you to learn, very little. I had to go to really boring apartment association meetings and things like that. So I did that, and over a period of about 3 years, I bought 3 apartment buildings, all pretty small properties, less than 30 units each. They were in Cleveland. And 3 years later, 3 years after I bought the first one, I sold those 3 properties, and I made $500,000. Okay, so I, imagine you're young, you're working, you went to school, you did everything you were supposed to do, and you weren't reaching your goals. You just couldn't see a path to where you wanted to live, and then you started this real estate thing on the side, only to realize that you made more money on the side doing this real estate thing than you did probably in the several years that you'd worked at Deloitte for that time. So it was at that point in my life, I said, you know what, this is what I got to do. And so I continued down that path. I will tell you, 25 years later, I'm thrilled to tell you I did put my kids through school. They're all doing well. They did not have to rack up any student debt. It was very rare that I missed one of my daughter's basketball games, my son's baseball games, their soccer games. I got to do Indian princesses and Indian guides, and I got to do all that stuff because I took the time to restructure my life and did the hard thing. I'm also thrilled to tell you that we have helped, well over several hundred people, investors, to their financial future what I've been able to do with mine. So that's a little bit of my background. I am thrilled that you're here. Let me get to my presentation, the real deal here. Let me do some screen sharing here. Give me 2 seconds to set this up. All right, so let's rock and roll here. All right, I do have to read this disclaimer because, well, that's what I have to do. All right, please note that investing in real estate and other financial instruments involves a high degree of risk and potential loss of some or all of your capital. This presentation is not an offer to buy or sell, or a solicitation of an offer to buy or sell any interest, securities, or otherwise to participate in any investment or trading strategy. Any offer like that can only be made through definitive legal documents, including an operating agreement, private placement memorandum, and other important documents. Whoops, I didn't mean to do that. Sorry about that. and I don't know it by heart, so I got to go back and read it. Sorry. Finally, note that nothing in this presentation should be construed as giving investment advice, tax advice, financial advice, or legal advice. Before making any investment decision, you really got to consult your own financial advisor. All right, 4 questions. If you saw the emails that went out that I promised to answer for you. Let me do some work here to admit I'm getting too many things on my screen. There we go. Why the bank crisis may not yet be over. What can the Federal Reserve really do about inflation? What is really happening on the ground? Boy, I'm having trouble with this computer today. And should you invest now or wait? So let's hop to it. In the beginning of these presentations, I want to always take you back to why we're doing this. And each time I do one of these presentations, I'm going to hit on a different topic. Now, I always talk about why I love multifamily. It's because it delivers cash flow, appreciation, and tax benefits. I'm going to dive into one of these here in a minute. On the cash flow side, remember, you have lots of tenants paying you rent. In our world, the expenses are fairly predictable. And as long as you get the management right, cash flow, revenue should exceed expenses, and that cash flow is paid to you. Now, I'm going to really focus on this cash flow component here in a second, so just bear with me. Secondly, you get appreciation. This is the big deal here. Real estate appreciates over time, but not just because. It does it because cash flow increases over time. I like it because it's really predictable, and I'm going to illustrate that here in a minute. The business plan that we adopt, the value add business plan, is designed to increase this cash flow, not just a little, but a lot. And the result of that is typically incredible appreciation. And then finally, tax benefits. When you get the cash flow distributions out of one of our funds, and most real estate funds, you don't pay tax on it when you get that money. It's because the IRS lets you take depreciation deductions, and that basically offsets the income on the property. And it's basically a book entry. It's really cool because your asset is generally going up in value, yet you're able to take depreciation deductions. And then finally, when you do sell it, if you don't do a 1031, capital gains usually enjoys significantly lower tax rates when you sell that, right? So there's a really good chance you could take some of that income, turn it from ordinary income into capital gains income. Now, when I told you I wanted to drill into the cash flow thing tonight, I was thinking about what I wanted to talk about tonight, and I really want to make sure that this message is clear, because this is what this business is all about. It is the reason that this business becomes more predictable, and it's why it's the only thing that I'll ever do again, I'm sure. So in our world, excuse me, I'm fighting a cold. It is always 100% about net operating income. That's basically operating cash flow. If you're a business owner, you're familiar with EBITDA. It's the same concept. If we're able to increase NOI, more meaning generate more operating cash flow, there's a pretty good chance that someone is going to be willing to pay me more for that, more because I'll have more cash flow, right? The asset generates cash. If I can make it generate more cash, it just stands to the reason that there's a pretty good chance that somebody's going to be willing to pay me more than what I paid for that asset that generates that income. If NOI increases, there's also a good chance that a lender might be willing to lend me more money on that property because it generates more cash. It's worth more money, and it can service more debt. So that's a second thing that I want. And there's a reason I'm laying all these out for you, because it's going to become a theme through tonight's whole presentation. If NOI increases, that new cash flow can also help protect me against inflation and higher interest rates. So what you see me talking about here, yes, there's positive things about increase in value and making money, but that increased cash flow also has a defensive component to it. Nobody ever talks about that, but I think that's really important, especially right now, because there's a lot of people thinking about what interest rates have done to their investments if they're in a deal now. Now, let me give you a real life example. And Max, do me a favor. If somebody jumps in the chat and has a question, feel free to if you think it's urgent, to interrupt me, okay?
Will do.
All right. So let's imagine, let's just pretend that we have an 84 unit property. Let's pretend that we're able to generate $357 more income per unit per month in new cash flow. And that cash flow most likely came from increased rents and maybe some other income that we were able to add to the property. And the cost for us to do those improvements was about $300,000. So how much new cash flow does that give you? That gives you $357 per unit times 84 units times 12 months. And I'm rounded here, about $360,000 in new cash flow. So here's what I would ask you. What do you think that $360,000 in new cash flow can do for us? Because it's not just one thing. First of all, and I'm going to lay out a bunch of scenarios, and you're going to see why we're talking about this tonight. Number one, it might get us up to $6 million in new value if you took that cash flow and used a 6 cap to cap that out, right? 360,000 divided by 0.06 gives you about 6 million if my math is right. It might also allow us to afford $360,000 in new interest expense. Now think about that. That might be useful, right? If interest rates rise, they might have done that recently. For example, a 1% rise in interest rates on a $10 million loan means it's another $100,000 a year in interest. So we can sustain a lot of new interest expense, right? It's very protective there. What if we actually had a cap rate that expired and we were no longer protected against that little insurance policy that holds our interest rate down? Boy, wouldn't it be great to have that $360,000 in new income to help pay for that and to keep us afloat and to make sure that we don't have a serious problem and not be able to service our debt. It might allow us to refinance out of a bridge loan. So even if rates went up a lot, you may be able to to refinance out of that bridge loan, maybe put it with a Fannie or Freddie loan, and you might even have enough money left over to pull some money out. Maybe. That's a possibility. It might protect us against, in case rents retrace a little. And by that, I mean, what if the market got a little soft? Well, I got $357 a month in income that if it went down to 337, right, that's, I got a little bit of protection there, right? I'm not going to go negative anytime soon. It might protect us against inflation. What if my operating expenses go up? Well, I've got $360,000 in new money to help offset that. It might, now I'm being kind of ridiculously iterative here, but what I'm trying to show you is how our business plan gives us so many opportunities, so many possibilities, not just in increase in value and making money. It is super protective and is part of the reason why our business plan works really well, even when we've had ridiculous interest rate increases like we've had. The last thing I would say, it might make it possible for us to continue cash flow distributions when a lot of other sponsors hadn't. If they weren't able to get enough new cash flow, they may not be able to do their distributions. So you can see, you're going to find out here in a minute that this is actually a real live example I just went through for you, and I'll tell you which property it is here in a minute. All right, KRI at a glance. I didn't update this much from the last month. We're at about 130 million. We haven't bought anything new since we talked. We've been trying since last month, but we have not struck gold yet. We are pursuing a deal right now that we think we like, but I've said that at least 10 times in the last 3 to 4 weeks. So hopefully we have one here. We're at about 240 plus or minus investors. I didn't recount them since our last time, so that's probably higher than that. I just didn't adjust the number. Cash flow we distributed last year was just under 700 grand. I did change this number. Our 2023 distribution goal is, I think it was 1.2 million. I've increased that goal to $2 million, and you'll hear why here shortly. But I'm hopeful that we can increase our distributions this year. That would make me super happy for sure. I do want to give you 3 real deals, the last deals that we turned. Some of you, if you're repeat, you've heard this before, you've seen these before. But I bring them up here because I just want to drive home this concept of more cash flow means more value, means it's how we make a lot of money. We did Coachman Club and Apartments. It was a 72 unit deal in Clearwater, Florida. We bought for just under 6 million, sold it for a little over 8. 2.5 years later, we moved rents from 785 to 11.25. That's a pretty big move. Even back then, when we had this property, it was. So that meant if you gave us 100 grand, 2.5 years later, we gave you back about 175 in total. Turns out that was the ROI to the investor an annual return on investment of about 30%. The second to last deal that we sold, Bell Reef Club Apartments. I think I've shared with you, this is also on our YouTube channel. If you haven't been to our YouTube channel, I would encourage you to go there. I've been trying to put a lot of good content on there for you. There's a video on there. It's about 20 minutes long. It's called the Jacksonville Turnaround Story. It is all about this deal, and you can see exactly what we did, how we did it, why we did it, and it'll give you a really good feel for how we actually do business. So that deal was 104 units in Jacksonville. We bought it for about $7.5 million, sold it for a little over $13 million 3.5 years later. And the only reason that took a little longer is because we had Hurricane Matthew come through. Didn't hurt the property at all, but it just took away all of our contractors who had to go to the coast and do a lot of roofing work. So we actually got our plans were delayed by like 9 months because we couldn't get contractors to come and do the work. We moved rents on that deal from $750 to about $9.25. So here again, if you put in $100 grand, 3.5 years later, you got about 177 back in total. Investor annual ROI is 22%. And what you're seeing there is the renovated pool. That picture is in the YouTube video, but you can see the grill in the background and the all new lawn furniture and the pavers, and the whole pool was remarcited. Trust me, if you go to that video, you will see it did not look like this when we started. That's for sure. And this is the last deal that we sold. We also sold this one coming out of the pandemic, similar to what we do with Bell Reef, 75 units in Orange City, Florida, little city northeast of Orlando, right off I-4. Bought it for about $5 million, sold it 2 years and a month later for $8 million, moved rents from about $700 to about $850. That one was it was a home run for sure. If you put in 100, you got back 172,000 over about a 2-year period. And that turned out to be a 36% annual ROI to the investors. If you are one of the folks that are in this, that are in our current fund, our last fund, there's the 84 unit deal in Tallahassee, Florida, the one that I just talked about at length, about what kind of opportunities, things we can do with that extra $30,000 a month. And we're working on that right now. 234 units in Bradenton, Florida. This is new information for you, that we have increased the average in-place rent on that property since June. We bought it end of June last year by $172 a unit. So I'm super excited about that. 55 units in Daytona, $8 million deal. That rent, those average in-place rents, we have moved by $176 per unit. So what's important here, you see rent growth, right? You're going to see a theme with us. Value add, increase income. It's always what our goal is. Last quarter, we distributed $300,000. We're going to do the same thing. We're doing distributions right now. If you're in the fund, you'll get your distributions here in the week or so. And I hope between the next couple distributions that we distribute even more. This particular picture that you're looking at is the Tallahassee deal. It's crossing at 2600. It's the leasing office. So that's to give you a feel for what it looks like. You can see it's super residential feeling, very wooded site. It's a beautiful little property. Excuse me. We are currently we continue to raise money for our second fund. Many of you on this call are already invested in that fund or committed in that fund. You have been super patient. I cannot thank you enough. My promise to you is I'm going to do everything I can to find the right deal. It is taking me longer than I want, but if you've been on a few of these calls, you probably know why. My job to try to make us money, not just deploy your capital as fast as we can. So this fund, our target continues to be an overall annual return of 15%. Part of that return is from the preferred return of 6%. So basically with us, you get your capital back, you get your preferred return, and then we split the profits 80-20, you getting 80% of that, of course. If we do need to raise additional funds to do a deal, you get right of first refusal on side raises. That's what they're called. They're called side raises. In our Bradenton deal, we did exactly that and gave you an opportunity to invest more money in that deal. And it basically the same terms. We try to keep the terms the same, but it just depends on the deal, what we're able to do with it. Minimum investment or commitments, $100,000. It's for accredited investors. We intend to hold our deals 3 to 5 years. each property. We can hold them longer if we need to, but it is our goal that we're only holding 3 to 5 years because we want to go in, do our thing, move income, and leave some for the next guy or gal because they need a reason to buy the property, and then sell it and return the money to you so you can determine and make your own decision as to whether or not you want to continue to reinvest. And most people do, but that's why we do that. I have learned that it is a really good business plan for people because it doesn't lock you up for 10, 15, 20 years at a time. And a lot of people, I think, really enjoy that. We continue to target Florida, the Southeast, Southwest. The fee structure here, you can look at it's a 1% acquisition disposition fee, 1.5% asset management fee. We're not here for the fees. Our fees are probably lower than most. We're here for the 80-20 split on the profit. That's what gets me excited, and that's what should get you excited. We do the fund model. We do that because in a syndication, that's what many of you are used to. In a syndication, you go out and you go out and find the deal, then you go raise the money, right? Well, that's harder to find the deal than when you're competing against me, because I go out, raise the money first, and then I go find the deal. And when I call a broker and tell them my fund is ready to go, we are ready to deploy capital, excuse me, they work really, really hard to try to find us deals. And when they go to sellers and they know they're dealing with a fund who's already raised the money, we get a massive buying advantage. We just do. The deals on that first fund, the first one never saw the market. The second two, we were not even the highest bidders. And we were awarded those deals because of our certainty of close. One of the things that most people don't think about, you think if you were, let's pretend like you committed tonight, oh, I want in, put me in for 100. You're not writing me a check for 100 right now. You're going to continue to stay invested in whatever you're invested in until we call the capital. That's important to me because I don't want your money sitting in our bank account, not earning what you could earn somewhere else. And as soon as I find the right deal, I will call the capital, and then we'll be off to the races. With a fund, you usually get, you hopefully get several assets in the fund. The last fund had 3 assets. So if you're in the last fund, you're in Tallahassee, Daytona, Bradenton. Those are hugely different property types, totally different geographies. It's really good diversification. And then finally, there's lower transaction costs usually with a fund because I don't have to go out and raise money 3 times. I'm only doing it 1 time. So it stands to reason that I'm going to have lower legal fees and everything else, and that accrues directly to you in terms of your profits. Lastly, in our world, it's a fund world. I told you, you get all your capital back and your preferred return, and only then do we get our profit component, right? Our performance bonus. But realize that I have to return all your capital for the entire fund, not just one deal. And don't lose sight of that, because that means I truly wait to the end, which as many of you know that I'm a firm believer in that. So I wait to the end in order to get paid last. So that's a huge benefit for you in that fund. All right, let's get to the real deal stuff. Let me take a sip here. On our last meeting, things were crazy. I mean, it was like night and day from today's April, so it would have been February, real deal, to the March, real deal. I mean, life couldn't have changed any more. Well, I'm proud to say that since then, I'm glad to say, I had nothing to do with it, but the FDIC did announce that they're going to guarantee everybody's bank deposits. That's huge. The Federal Reserve is now allowing banks to borrow against mortgage-backed securities and treasuries that the banks hold. But here's the key. Even though those securities aren't worth what they were when they bought them, the Federal Reserve is allowing the banks to pretend like they didn't go down in value, and they're able to use them as collateral. So they're basically allowing them to borrow against collateral that really isn't there. Huge benefit to the banks, of course. I'm glad to say that the failed banks have now found new owners, and there's no question interest rate volatility has decreased considerably since last month. What a difference a month makes, man. Yesterday, CPI, if you don't know what that is, Consumer Price Index, it came in at only 0.1% month over month and 5% year over year. That was below expectations. That's good. The reason it's good is because it shows that the Fed's efforts to reduce inflation, which is what they're hell-bent on doing, is starting to take hold. PPI, this morning it was announced the Producers Price Index was actually negative 0.5% month over month. So that means prices actually went down at that level. That's the Producer Price Index. I'm not going to get into the details of what that is, but the point is, it's not, the prices are not going up. They clearly did not expect a negative 0.5% change. So that's huge, I think. They did reveal that the Fed minutes from the last meeting did show that they think the bank problems are going to increase the risk of recession in the latter part of 22 or 23, that latter part of this year. That's important for two reasons. One, that means the Fed is getting a little help from the market, so to speak, because the recession means people are spending less, some people will lose their jobs. And it also is because when banks have problems, they tend to tighten their credit and not lend as freely. And so that just makes it harder to spend money. And that when you're using all of these things together to reduce demand, it's a good thing for inflation. The biggest rate drop that we have seen in the last 30 days has been between the 3 and the 7-year Treasury. I'm watching the 5 mostly, but it depends on the minute, but it's between 40 and 60 basis points. So that's roughly 0.5% down in a month. That's a big deal. I mean, in that $10 million mortgage, I think that is $50,000 a year. It's a lot of money. Imagine, our Bradenton deal, we have, I don't know, a $30 million mortgage. So, that's $150,000 a year in interest if that debt was floating, and it's not. This could provide some refinance relief for some people that makes it possible, or it makes it more possible for them to get a refinance in place if they're in trouble because their rate cap's expiring. What's next? I think most people think the Fed is close to done raising rates. Nobody really knows, but I think the general consensus is they're getting closer to being done. The interest rate markets are definitely settling down, at least for now. Who knows what happens when I talk to you next month? It might be completely different. I hope not, but it's possible. The Fed does seem to be getting some help reducing demand from the banks tightening credit. We talked a little bit about that. I believe that the biggest elephant in the room right now are office building loans. I think they're kind of at risk. I think as these companies renew their leases, they're reducing their footprint, and banks are lending at lower values on these buildings. And about 80% of these loans are originated by regional banks. That's part of the reason why I said, I think the banks, well, I'll tell you, the banks I don't think are out of the woods just yet. It might be the next shoe to drop in the banking world. I don't know. What I do know is that those losses will be real. There will be people walking away from their deals. They'll hand the buildings back to the bank and, wish them the best of luck. And that's going to be tough for the banks. So there will be losses on the bank's balance sheets, no question. All right, so let's get back to my 4 questions that I promised to answer. Why the bank crisis may not be over. I think I just talked a little bit about that with the office loan thing. It does have me a little worried. I mean, I'm not an extremist by any stretch, but it does have me a little worried that there's going to be some turmoil there for sure. When you stack that on top of the fact that banks are still carrying unrealized losses from their treasuries and the mortgage-backed securities they're holding, and what that means is, rates went up. If you were on the last call, I talked about rates going up, price of those securities going down. That means there's losses sitting on their balance sheet. And I believe, don't quote me on this, but I believe as long as they're classifying and intending to hold those securities till maturity, they don't have to realize those losses. They don't have to recognize them. So they're kind of just sitting there unrealized, but eventually it might eat away at their capital. Some of the multifamily deals, we've talked about this, are definitely struggling because they may not be able to refinance. So when you stack these 3 things on top of each other, the bank crisis may not be over. I think most people would argue that no depositor is probably going to lose money. But if you were an equity owner or a bond holder for any of the banks that failed, you didn't feel quite as happy as a depositor did because you lost an enormous amount of money. All right, what can the Feds really do about inflation? Remember, if you go back to my first in February, that meeting, we talked about this explosion of demand and is what caused this inflation. And so basically it was like a light switch. Demand exploded instantly. the supply chain, it just takes a while for it to recover. You can't turn the supply chain switch on like you can the demand switch. So you just had massive inflation. That's what caused that. Problem is, all the Fed's tools are designed, or most of them are designed, to reduce demand. Basically, and this is a tough way to hear this, but basically the Fed's tools are designed to destroy consumer and business wealth so that they stop buying. If your apartment building is worth less because rates went up, well, that just took away a bunch of your wealth, right? If you're not able to buy a house anymore, or your house is worth less because people can't afford it because the rates are up, that means you're not as wealthy. So their tools are meant to destroy wealth. I hate that concept, but that is what it is. I don't think they have much in their little toolbox to tackle the supply side of the equation, which was really the problem in most cases, why inflation spiked the way it did. So I'm hopeful that inflation continues to decline. It seems like it is going to, but I don't have a crystal ball here. But I know that the Fed has limited tools left other than just rate increases and doing what they're doing. So hopefully what they're doing is going to continue to work. All right, what's really going on out there? This is no different than the last month when we had this conversation. A lot of sponsors have variable rate loans, and their interest expense is eating up all their cash. Some sponsors have lenders that are requiring them to escrow money in advance of having to buy the rate cap, so they have the money to buy it when it's necessary. So that is just sucking up a lot of their cash. Some sponsors, some of them can't even pay their debt service already, and they're doing cash calls. Hopefully none of you are investors in any of those deals, because it really sucks when your sponsor has a cash call. But in any event, it is happening out there. I know that it is. We, as a KRI, we have good rate protection. Our markets continue to be very strong, so we do plan to continue distributions. Should you invest now? I still think this is a good time to invest. I don't think cap rates are going a lot higher. Again, I don't have a crystal ball, but it just seems like they're not going to go a lot higher. Presumably inflation will continue to moderate. And if that's the case, the Fed shouldn't have a lot of reasons to raise rates. We'll see. That's why I don't think rates are going a lot higher. It might be possible. I am not underwriting this in any of our deals, and let me be clear on that. It's possible we'll get some cap rate compression over the next 5 years, but there's no way I'm willing to underwrite that in our deals. So if we do get it, it'll be icing on the cake. The insurance problem might start to get under control. I tell you this because, I'll tell you here in a second, but we did just get a 6-month extension on our property insurance on our Bradenton deal with no increase. Like, that's unheard of. I did hear Warren Buffett yesterday on CNBC. He owns a few insurance companies. You probably know that, but he specifically mentioned that their insurance companies were getting much more interested in going back into the markets that they abandoned because pricing was much more appealing, and they felt like they could make money at this pricing. So what happens in the insurance world, things get ugly, everybody leaves, capacity is reduced, prices go way up. That entices people to get underwriters to get back in the market, the capacity expands, and then the prices go down. It's a cycle. I have literally watched it happen at least 3 times in my career, and I think we might be coming up on that downside of that cycle. I'm not willing to say it's there yet, but imagine if we were able to pick up deals at a higher cap rate with really high insurance numbers, we might stand to get some good benefit just with tailwinds, right? I will tell you right now, I think it's super important that you continue to follow the vetting rules. I laid some out in the last meeting, my 4 rules. Just follow them. Please follow them. Stay super disciplined when you're underwriting. Don't take any guesses. Don't leave anything to chance. And whatever you do, don't reach. Don't get FOMO, right? Fear of missing out. On our properties, give me just a second here. All of our properties continue to be at 95% or higher. Our Bradenton property is 95% pre-leased because we're continuing to turn that property around. Delinquencies continue to be low. That's really important. Rents remain very strong. I am not seeing any retracement. I'll give you an example. Our leasing traffic continues in our markets to be insanely strong. I will tell you, I just looked this morning because I wanted to update this number for you. Our Bradenton property had 210 leads for an apartment, and this is what, the 13th of April? I mean, that's just crazy traffic. It is very difficult for us to even keep up with that much traffic. So that is very high demand. That is really important. That's why I love being in high demand markets, because even when things are struggling, some parts of the country, we are not. On average, I took a look at March because I wanted to give you real on the ground intel. This is real stuff out of our system. Right now, our portfolio average rents in March across our portfolio, our own portfolio, new leases were up 25%. So when somebody moved out, some new person moved in, we were able to get 25% more in rent. Our renewals are about 12.5%. So that's really, really strong. It's because we're value add investors, right? We're adding value to the property, and our rents were under market. And so we're bringing them up. We have no concessions in place. On the insurance on the insurance front, I just told you we got a flat rate 6-month extension on Bradenton, and on our Daytona property, we only got a 19% increase. I know only 19% seems a little odd to say out loud, but trust me, there are people that are getting doubles. So we're pretty happy with the way that is performing for us. On the debt side, we are being very proactive here. I will tell you, I don't know, 2 or 3 weeks ago, it was literally right after the last crazy crash when rates plummeted, and I really wanted that day to be able to lock in rates. And I thought, you know what, I got to do something here. So what we did is, for 2 of our properties, we decided to go ahead and order all the third-party reports, the appraisal, the environmental, the property condition report, and have them literally just waiting. They're good for several months. And so the reason I'm doing that is it gives us the opportunity to lock in a rate. As soon as we see rates where we're happy, we can literally within a day lock them in. So we're trying to be proactive. And if rates spike on us, that's okay. We've only wasted a few $1,000. It is well worth the opportunity to lock in rates should we want to do that. Now, in the Tallahassee deal, we still got 2 years left on our loan, so before our rate cap comes up. So we've got plenty of time. We've also got plenty of cash. So that is one property where we may do that. I think if everything goes according to plan, I think we'll be able to put 5-year debt on that property and actually reduce our interest rate. So I'm super excited about that. We have another deal that we've held for 6 years. If we do the same strategy with that property, and I'm not saying we're going to do this either one, I'm just telling you that I'm being prepared, trying to be proactive and be very strategic about how we do this to continue to manage interest rate risk and just be smart about how we run these properties. If we do that on this other property, we should have no trouble returning the rest of the investor capital and distribute another probably $1.5 million out to the investors. So certainly a win-win there, and it's why I'm fairly optimistic. My observations from all this, just remember, do your homework before you buy. I know I keep saying that, but I talk to people every day, and they want deals so bad, they continue to cut corners. Operations matters, especially now. Don't let anybody tell you it doesn't, right? Continue to invest with firms that have experience. I'm trying to share with you some of the things that we are doing, and some of the things that we're doing, we do them because I've been through so many cycles and I've seen so many things happen, and it's my job to navigate us through these troubled waters, right? And make sure I do everything possible to make sure we do well. I believe our investment thesis continues to serve us well, whether we're in an up market, down market, whatever. I leave it here on the screen for you to see, but the keys here: growing areas, good neighborhoods, and we're able to significantly improve cash flow. It is the reason that we're getting the price increase, the rent increases that we are. It's because that demand supply imbalance is just insanely out of whack in our favor. All right, these are our, I just want to remind you, these are our funds. We'd love to have some of you in their fund, in our, talk to us about our fund. Max is here, reach out to us, scan that QR code if you want to, gives you all the information you want. I'm not going to, we're not going to certainly track you down and hunt you down, but I think what we're doing is a good thing. I think we'll continue to be really successful. And if you want, you can certainly just call us and have a discussion with us. These kind of funds are not for everybody. I recognize that. What's really important is that if we do talk to you live, I'm going to make sure that what you're trying to do does match up with what we're able to do, or what what our investments are designed to do. So, just because you call doesn't mean that it's a good thing. I want to make sure that you're right. It's a right thing for you. And I can, with a conscience say, yeah, your goal matches what we're trying to do. It's something you should look at getting into. But, the biggest thing is if you need money in 6 months, don't go into the fund, because I can't get it back out to you in 6 months. That would be unreasonable. It's those kind of things that we want to talk about when we talk with you. So, all right, I have been talking and talking and talking. Anybody have any questions at all?
Question about refis.
Yes.
Question about quarterly distributions. Question about capital call. And just to verify, the asset management fee of 1.5%, that's annual.
Yes. So let's go one question at a time. What was the first one?
If you refi and any of that refi flow to the investors, if you refi and get a bigger loan and you don't need all of it for, let's say, management or improvements, did I understand that some of it could go back to the investors?
Yeah, absolutely. Yeah, so it's the deal that I'm talking about. Our investors still have 800,000 in it. I think we'll probably be able to get out a couple million, maybe a little more. So we will return that 800, and we might take a little in the bank just because it would be foolish to distribute everything you have, and then the rest of it goes back to the investors pro rata. So if you were 10% of that deal, you're going to get 10% of that money.
So what's nice about that, and I hadn't realized it until I benefited from such a thing, is that the return of part of the refi is not income. It's debt, actually. So there's absolutely no taxes to be paid.
I'm so thrilled that you brought that. You're right. You're exactly right, Jerry. When that money is distributed to you, that is not a taxable event.
Right.
Yep. It lowers your tax basis. It does. Eventually the tax man cometh, but no, you do not pay tax when that money comes out to you. So that's huge.
Right. How do the quarterly distributions work? I was fixated on the return on investment percentages that you posted, but the quarterly distributions feed into that, or they're separate from that?
Yeah, no, it's that. Yeah, you're exactly right. It does feed into it. So in our world, we have a 6% preferred return. So that doesn't guarantee you a 6% return. That means you get the first 6%. And so we distribute that. If we distribute quarterly, that our goal is 1.5% per quarter. Right? 1.5 times 4 is 6. So that's how that works. So then when we calculate that ROI percent, that number, those 36%, the 30%, excuse me, I'm sorry, I'm fighting a cold off here. So we take all of the cash that you put in and consider all the cash you got back and then divide that out. So it includes that distribution. Most of the money you make in this business is generally on the appreciation. Or at least that's the goal.
How do you guarantee the what do you call it, the capital call? Is that legal agreement that you sign when you sign up for the fund?
Yep. So yeah. So what happens is there's a couple of things you get. I need to give you a private placement memorandum, and I know Max will get you one after the call. You'll get the operating agreement, which governs our relationship because we're all partners. And then the third is the subscription agreement. That's the document that you use to sign up. And so basically you take a look at those documents. We do all the hard work. We'll fill it all out for you. So all you got to do is sign it. But that's all you do. That's all you need to do is fill that out. But I do need you to see all those docs first before you can commit. And that, yeah, so yeah, that's a legally. So let's play this out a little bit for you so you understand how it works. So let's say today, let's pretend like you committed 100 today. You're not going to send me any money. Let's say tomorrow, I'm making things up here. Let's say I got to use even numbers. I raised a total of $15 million. And the first deal I find needs 5. And you committed 100. So 5 out of 15, I need a third of your capital. So I'm going to do what's called a heads up notice. I'm going to tell you, hey, we're very soon here. We're going to call a third of your capital. If you need to move money around, please do it now. Then we'll send you the official capital call. You send us the money. As soon as we do that first capital call, no one else is allowed in that fund. It becomes a closed fund then, right? And whatever percentage you are of the total, that's fixed. So then we buy that deal. I go find another one, maybe another 5 million. I call the second third, and I call the third, and whatever has been deployed, that's what you're earning that preferred return on.
Right.
Does that make sense?
Yep. I've been doing private placements, but not in a fund. So the fund part of it is a new.
It is. It's the private equity concept. It's exactly what it is. The benefits are huge though, because I used to remember we buy in very competitive markets. Even now it's competitive. When there's a good deal out there, there's 10 guys trying to get it. And so most of those people they say to the broker, to the seller, hey, give me the deal. I promise you I'll go raise the money. Well, here comes us, Mr. Broker, we've already raised the money. You don't have to worry about that anymore. And so that just gives us a huge advantage. And that's the real reason that I flipped to that fund model. I mean, I prefer to do one-on-one syndications, but I need to find a way to differentiate ourselves in a very competitive market. And that's how we're doing it. And it's been working beautifully.
I understood. I was surprised that you showed a 95% occupancy rate. Is there an intermediate period where you first acquire a building? Depending on how much upgrade it needs, it would seem that you need to have vacancies in order to do the work for at least a while.
Yeah, that's a really good point. So usually it depends on how I call it a heavy lift. It depends on how heavy the lift is. In some properties, most of the time we're able to stay over 90% when we do these, because we don't throw everybody out and then renovate. That's not what we do. As the units turn, we renovate them. We usually do the common areas first. Nobody gets thrown out for that. And then while whenever people move, we go in, we renovate the unit or do whatever it is we're going to do, re-rent it at the new rate. That's why you saw those huge differentiations between renewal rate of 12.5 and I don't remember what the new one was, like 23%. That's why you see that big jump. Now in the Bradenton property, that was a much heavier lift. Since we'll call it July 1st of last year, we've already turned about 95 units. So that was a heavier lift. We were in the 80s. We are pre-leased into the 90s. So when I say pre-leased, that means we have vacant units that we're turning. They're already leased. We have people on notice to vacate. They're already leased. So when I say pre-lease, that's important. So now it becomes turn these units as fast as you can because people are waiting. They're literally waiting to get in. And the only thing slowing it down is our ability to turn units fast. But that's what happens when you're in a really high growth market. Now I can compare that to a low growth market for you, because the first 10 years of my business, I grew up in Cleveland, and it is the exact opposite. We were just, we had concessions all the time in Cleveland. It was much harder to find tenants because there weren't just people coming to live in Cleveland, right? It's not a place that people yearn to live. Most people come from Cleveland and go somewhere else. So I've had both of those opportunities. I've had the opportunity to manage both of those situations, and that's why we don't do anything in Cleveland anymore.
One last thing comes to mind. I understand that there are different classes of multifamily buildings that could be Class A, Class B, Class C, et cetera.
Yep.
Do you limit? I mean, what's your target in the class structure?
Yeah, it's in the B, C plus. So let me tell you why though. The why is the key. So if you look at the A properties,
they don't need as much work.
Well, they don't. You're right. They're beautiful, right? You generally need to hold them longer to make money. But more importantly, in my mind, when, and this is happening right now, and some of the people on this call will be able to verify that's happening in their market. Builders start building. Builders always overbuild. I don't know why they do it, but they do it. So then all of a sudden, here comes this mass of new supply into the market, and it affects that A class property considerably because the builders offer ridiculous concessions. Their goal is to just fill it up as fast as they can so they can keep churning through the various phases of the project. Now, let's look at the opposite part of that spectrum, and that is the C minus stuff, right? The rough neighborhoods. Think about what happens when you get a recession. Those people always get hurt the worst. Always. They just do. And so we don't like that part of the market just for that reason. Plus, it's a dogfight to get paid on a regular basis. I know because I used to do that earlier on in my career, and it's not a lot of fun. So we stay in the middle, right? And I like the middle because think about Florida. About 900 people are moving to Florida every day. That's fact. I mean, that's census information. Most of those people are just normal people. Some of them are wealthy, and the Class A buildings are taking care of those people. But most of them are just normal people, and they want a nice place to live, but they don't want to pay $3,000-4,000 a month for rent. So, but here's the problem. We have this really high demand, but they're not building anymore. So we have a supply, the inventory is stagnant. There's no new inventory and lots of new demand. That gives us the ability to put upward pressure on rents. That's one of the reasons that our business plan works so well. So we're kind of insulated. It's not perfect, all right, but we're kind of insulated from overbuilding. We're kind of insulated from recessions. We're in the middle, and that's why I like the high growth market, because it's hard. I mean, the demand is so much higher than the inventory that's available. A lot of demand has to go away in order for us to really get hurt. Does that make sense? And that's why we stay in the middle.
Thank you.
You're welcome. I appreciate your questions, Jerry. Do we have your email? If you could.
I get your email. I get yours.
You do? Okay. Well, Max, if you wouldn't mind making sure that you shoot Jerry, a packet. We'll send you the packet so you can read all the stuff, and then we can jump on a private call.
Thank you. When you're raising capital for a fund, is there a limit to how much you're trying to get? I mean, you have target buildings. And if I understood, when you actually close or have a accepted offer, that fund is closed, or when does it close? But
yeah, good question. So first of all, the documents allow me to go to 50 million. I have no interest in going to 50 million in money raised because it's just too big. I can't deploy that money fast enough, right? I'm having trouble deploying what I have. Excuse me. My goal is $10 to $15 million in the fund. That's a good size fund. I can buy 2 or 3 deals with that much money, and everybody's comfortable. It's not crazy big. Now, here's how the fund closes, right? I don't like open-ended funds. The reason is I could go buy 2 deals and then bring in a bunch of new investors and use that money to go pay distributions to everybody, right? What's that sound like to you?
Ponzi.
That sounds like a Ponzi scheme, and I have no interest in even having anything that could ever even remotely look like that. So what I do instead is I'm going to have what's called a heads up notice. Let's say you're in, or you're about to be in. I say, all right, heads up, guys. I'm going to call this capital. I'm going to send you a notice in 2 weeks. I'm kind of making up dates here, but in 2 weeks, I'm going to do the official capital call. And what happens in our world, there's a lot of guys that say, okay, I'm in for 100, but I want to go to 300. I'm just going to wait until you do that capital call. So I do that heads up notice, tell everybody, you guys, we got to finalize your numbers right now. If you want in, you want up, now's the only time you can do that. They all rush and do that. That's what happens. This is what really happens. Then we finalize it. Okay, as soon as I do that calculation, we're done. I know how much money I need from you. I know how much money I need from the next guy, and nobody else is allowed in the fund then.
So there can be a scenario where you say, well, I can't handle the 300. I can only handle 2, or
no, that probably won't. Yeah. So we're here now. Let's fast forward. So as soon as I close that first deal and the fund is closed and I've deployed some of your money, that starts the clock ticking on what's called the commitment period. Private equity funds have something called a commitment period. That means that I have 18 months from that first capital call to deploy the rest of your money. If I don't deploy it in 18 months, you're good. You don't have to send any more of that money. Your commitment for additional funds is sort of off the hook. Does that make sense? Because otherwise I could stretch you out for years and years, and that wouldn't be.
As far as any further capital call.
Yeah.
Okay. Just a question about how you run these programs. Am I to understand you have a monthly repeat of some sort of what you did tonight?
Yeah. So what we did is I usually get passionate about things, and that drives me to do things. That's usually what happens in my life. And I get so tired of seeing ridiculous headlines and people, extreme views and all this stuff out there. I want people to know what's actually happening on the ground. So that's when I said, you know what? We got to do this real deal webinar and tell people what's really going on. I do it once a month. It's just something that I do because I want to have real conversations with guys like you to tell you what's really going on. Forget about all the headlines, forget about this and that. We're not Blackstone, we're a normal company doing business on the ground, and this is what's actually happening.
So I don't want to complicate your life, but I was wondering if there was a way to have a more succinct update at some point. Is it just by emailing or calling? Because the first half hour is basically recapitulating what we've heard before when you do the webinar.
Yeah. So I you know what? It's good feedback. I will reduce that time. All right. What I wrestle with is, Jerry, a lot of times when I do these calls, I have new people that don't have the level of knowledge you do. And I risk leaving them in the weeds. You know what I mean? I don't want to leave them behind. So I will do my best to try to make it as succinct as I can. I promise you I'll do that. The other thing that you can do is you can also, I want you to come live because I want to be able to talk to you about what's on your mind. But if you certainly can listen to the replays as well and fast forward through all the boring stuff, I guess. I don't know. Right. It's like watching a commercial, but you understand why I wrestle. I try to give a little bit for everybody because not everybody is going to be at your point. You're a very knowledgeable guy, and not everybody is at that point.
Is there any sticky wicket in terms of beneficiaries? I mean, my age is not reversing, so you name beneficiaries in the private placement, and you must have some experience with that.
Yeah, there are people who invest through trusts. They use that mechanism so that they control exactly what happens. There are people that invest through their IRAs, and those IRAs have defined beneficiaries. There are people who just invest as individuals. There are people who invest as LLCs. I mean, whatever mechanism you use, there's all over the map. People do.
I've been doing it through revocable trusts, so that's what I would continue with.
You are not alone. We have a lot of people that do that. Yep.
Right. Thank you.
You're welcome. No, Jerry, I love your questions, man. These are great questions because a lot of people on this call, they won't answer those questions. So
I hope it helps. Thank you.
It does me. Thank you. All right, my friend, what's happening?
Hey, good to see you, Ken.
Good to see you, man.
Okay, some good stuff going on here. But my biggest question is that, yes, it's hard to find a deal, but a lot of the stuff that the brokers are sending me is vacant warehouses or land or stuff that you can build on right now. What do you think about that process? I mean, I know it's out of your normal buy routine, but
yeah,
what do you think about that going on right now?
Yeah, so let's tackle them one at a time. I don't like land. The reason I don't like land is it doesn't generate any income. It just doesn't. You have to hold it, right? You're a builder, as I recall. Yep. You know how to do this stuff. So land is valuable to you, right? You know exactly what you're going to do with land. I'm not a builder. That's the one thing we've never done. So when I think about land, I don't know what to do with it, right? I don't know how to make it generate income while I'm waiting to build on it. The warehouse stuff, I get worried. See, the closer you get to business, the more recession exposed you become. Now, if you're in a single tenant warehouse, I mean, man, you're not only dependent on business, but you're dependent on one business. And I like that even less because what I try to do, the reason I like multifamily is I get so many ways to mitigate risk, right? People are going to need a place to live. As long as I don't buy next to a single employer or a military base, I get lots of different revenue streams, right? From lots of different employers. And you can see everything about what we do attempts to mitigate risk. And when I look at warehouse, like think about, I mean, Amazon, what, didn't they just cut like a whole lot of jobs? And, you know, there's talk that they might cut back on some of those warehouses. See, I don't want that kind of risk, right? If I can earn 20+% annual returns in a relatively low risk asset, I can't say it's safe. You're not allowed to say that, but it's a relatively low risk asset. Like why do I need to go dabble in those other places?
Well, I was kind of asking you about, you've been in this so long, to like, have you seen the trends where, okay, if the multifamilies are not quite selling, that's why brokers are going to push land or empty warehouses or stuff, because they still got to eat.
That's exactly what I was just going to say. They still got to eat. They're going to try to sell ice to the Eskimo. I mean, they just are. And I don't blame them. It's just not what I do. I want to make money. I want to do. Remember, I'm using your money and other people's money to do this. And I want to do everything I can to make sure I don't have to have a tough discussion with somebody. I've never had to do that, and I don't want to have to do that. The thought of doing it really, I mean, that just it's very unsettling. So if I'd rather say, oh, we didn't earn 50%, we only earned 30. Like, who's going to complain about that, right? I like that scenario. I like that setup. I know you're laughing at me, but that's really why I do what I do. So I look at office. Office scares the hell out of me, especially right now, right? Some people might think they're opportunistic. They might think now is the best time to buy it. If that's what they think, their risk profile is different than mine. Medical, I don't know. I don't know if the teledoc stuff is a big deal, right? The virtual medicine, I don't know how that's going to impact that kind of thing. Think about self-storage, right? Self-storage is kind of, although a lot of people love it, it's discretionary, right? I mean, you can take your stuff and cram it somewhere else and not pay for storage, right? I can see that happening. Let me think of what else. Airbnb, that kind of stuff. I'm not a fan of that. That's kind of like running a hotel, right? And there's so many people right now, so many localities that are outlawing those things. Excuse me, they're making them illegal. Now I worry that the government's going to make my business plan. You know, I bought this property, it's in a municipality, and suddenly they, with a stroke of a pen, say what I do is no longer legal. I'm like, Jesus, now what am I going to do? See, I don't like those risks. So when I just keep coming back to multifamily because I can't find a better way to do this without taking on risks that I'm not comfortable with.
Right.
Does that help you?
Yeah. And just, I don't know if I can word it this way, from a former student, Eureka and I just put an LOI in for 30 units.
Awesome. Congratulations, man.
You're
awesome.
Following your
Uh-oh, you broke up. You stopped.
I said, you there?
Yeah, now I am. Yeah. What'd you say?
I said, following your program and what you taught us, you know, checking all the boxes, but our criteria, we just put an LOI in for 30 units.
Awesome. Well, congrats, man. Let me know if there's anything I can do to help you.
Yeah, I'll know on Tuesday. They told me Tuesday they'll give me an answer.
You know what you do? You call them on Monday and find out how's it going, what's happening.
Okay.
Where am I at? Where am I at? Now, you know, I want this deal. Tell me what, be straight with me. Tell me what's going on.
Okay.
Right. And you might learn something, you might not. Just, you got to take what they say with a grain of salt, but at least if you're going down in that pile because they don't know you very well, that just brought you back to the top.
Yeah, this broker knows me well.
Do the broker knows you well?
Do that. Yeah, he knows me well, and
All
that's
right.
probably one reason I made it to the end of the LOIs, is because he knows.
Well,
So,
go get it, man.
still
I'm
gonna
super
call him.
excited for you too, because I know you two did your homework. I know you did. I know you did. That's awesome.
Thanks.
All right, man. Good luck. Keep me posted. All right.
Yep.
Well, nice to see you again. How are you?
Hello, Ken. Hello, everybody. This is Ange from the Clearwater, St. Pete area. Thanks for an informative presentation, Ken. Question about depreciation.
Mhm.
About what percentage of depreciation do you typically anticipate, or what percentage of the depreciable basis do you typically anticipate for?
Yeah, so that's a great
accelerated depreciation for the type of properties you're looking at.
Yeah, there's a bunch of laws that go in play here. What you're supposed to do is divide your purchase into real property and personal property. I'm going to do this from a high level, okay? And then many people will do what's called a cost segregation study. We do it. We hire an engineering firm to actually go to the property. They're legitimately engineers. These are licensed engineers, and they document all the little bits and pieces of that property, reclassify the property into IRS buckets that generally has the effect of what maybe I thought of as real property. It's actually personal property. So the reason that matters is you can depreciate personal property over a much shorter lifespan, right? Excuse me. Now to add on, so that's good in and of itself. Then you add on the benefit that the government gave us called bonus depreciation that basically says, oh, all that personal property that you bought, well, guess what? You don't have to write it off over 5 years or 7 years. How about we let you do it over 1 year? Like, oh my God, this is unbelievable. So last year it was 100% of that. This year it's 80% of that, I believe. You got to verify this, but I'm not an accountant anymore. I just play one on TV. But so in our deals last year, we were generally, now across the portfolio, we're able to get you depreciate or tax deductions in the amount of about, on average, 85% of the equity that you put into the deal. It just happens to be the way the numbers shook out. Okay. So they were able to classify a lot of that property as personal property. And then the depreciation deductions flow through to all the partners because I don't specially allocate it to myself. Everybody gets their share of it, right? It's pro rata. And then you decide whether or not you can use that depreciation deduction to offset other income. If you can't, you simply keep it and carry it forward until there is income from the property. Then you have all these losses there to offset the income.
Mm-hmm. Yeah, thank you. That's a very high percentage of depreciation. Is that typical?
Well, it's only because of the bonus depreciation. If that bonus depreciation wasn't there, that wouldn't even be close to that.
Okay.
It would be much less.
So okay.
Now
So,
here's, oh, go ahead, finish.
So let me just say this. If say we had a property and the depreciable basis was $1 million,
Mm-hmm.
what would the cost segregation study, I mean, I know it's ballpark and the engineers haven't done the analysis yet, but just from your experience, ballpark, I meant what percentage of that depreciable basis do you typically see
Yeah.
extract from the cost seg study?
Yeah, so it's going to depend. If you have a property like our Daytona property, has no pool, has no amenities really, there's nothing to depreciate. There's very little personal property there. That number, I don't have it in front of me. I'm going to say it was around 60% of what of the equity in that deal was able to get a deduction. So if you put in 100, you're usually able to get 60 there. But compare that to our Bradenton deal. Because we're turning that property around and fixing a lot of things and spending a lot of money, there were actual, improvement losses. Plus there was the cost seg. I mean, I think it was probably pretty close to 100% of your equity was deducted. Part of that was real losses, right? Because we were fixing so many things, and a good chunk of that was from the cost seg.
Okay.
So it does vary. On average for our portfolio, it was 85%, excuse me.
Okay. No, that's helpful to know.
Yeah, what's really important though is I want you to remember, and this is a CPA and me coming back, do the economics first. Let the tax thing be the icing on the cake. Okay? Because remember, all tax benefits eventually turn. Eventually. Right? They eventually turn around on you. So the reason you don't pay taxes, they allow you to reduce your capital, your basis, your tax basis. But if you were to sell that property the next day, you'd have all that gain.
Yeah, you'd have to recapture. Yeah.
It's
right.
called, well, recapture is a technical term, so be careful with that.
It's a gain.
You have to recover, you're going to have a lower tax basis. So the reason I tell you that is I want you to focus on the economics of the deal first. Make sure this thing cash flows, right? None of the deals that we do are tax credit deals or any of that stuff we're not buying tax benefits. Now, a lot of people do it anyway. They'll, you know, they're doing it for the tax benefits, but I want you to do for the economics first. And then the tax benefits is just a little icing for you.
Okay,
All right.
great, thanks.
Hello there. How are you?
Hi, Ken. I'm well. How are you?
I'm doing great.
Curious question.
Yes.
If you have paid back your investors, what they've invested plus, you've met the IRR that you somewhat promised. You didn't guarantee it, but you know, that was the IRR. And you're still in the deal. If you did that via refinancing and you're still in the deal, do you continue to pay out 80/20? Okay.
Yeah, let's say I got you all your capital back and your preferred return, right? We're splitting everything 80/20. You get 80, I get 20.
For the life of the investment.
Yeah. Yeah, we're not going to
Okay.
kick you out. Yeah, there's some deals and syndication and funds that kick you out after they get your money back. We don't, that's not cool. I don't like that. You took the risk with me in the beginning. You should stay in all the way to the end. That's the way I feel. It wouldn't be fair for me to, otherwise then you're just a lender with a fixed return. Right?
Right.
You should get all the upside, not just some of it. That's what I think. So that's a really good question. I'm glad you brought it up.
Thank you.
You're welcome. And I think that just made Jerry think of something. All right. Yes, sir.
So how many properties might be in a single fund?
I don't know exactly how many will be in the fund. It'll depend on the size of them. The last fund had 3.
Now, what happens?
My goal is 2 to 3. That's my goal.
What exactly happens when one of them is sold and the other ones continue?
Yeah, great question. So now let's remember, you and I had that example going, 5 million, 5 million, and 5 million. Let's say that first deal in, I sold it. Let's pretend like we made $3 million on it. I'm making stuff up for you. Okay. So if the profit was 3 million, that means you're going to get the 5 million you initially put in on that deal. Plus there's 3 million of profit. You're getting all that too on that first sale. Why are you getting it? You're getting it. I'm sorry.
Your percentage of that you invested in the fund.
Yes. I'm pretending like I'm pretending. Yes, that's correct. All right. Let's say you're the full 5 million. Okay. Just to keep it, I'm trying to keep math easy for myself. So you're all the 5 million, there's 3 million of profit. You're going to get your 5 plus 3. But here's the deal. You've invested a total of 15 million in the fund. So there's no profit for me yet because I haven't returned all your capital. I will have only returned 8 million out of the 15. Sale number 2 comes around. If it does the exact same thing, you're still left, your capital is 7 million. So you're going to get 5. And then there's going to be profit of 3. You're going to get 2. And I'll have to make sure you've gotten your preferred return. And as long as you did, we're going to the 80/20 split done on that extra million. You see, so I have to wait until you get all your money back. I call it putting your investors first, right? Because that's what I like to do.
And when the third one sells, that fund, it ends. It's closed.
The fund is closed. Yeah, it's a closed fund, right? Once I do that first capital call, nobody new is allowed in the fund.
No, I mean after, let's say there are 3 buildings in the fund, you just outlined the sale of the first 2. When the third one is sold, then there's nothing left, and everything is paid out, and that one ends.
It all goes away. Yep, the fund goes away. Yep.
Okay, thank you.
You're welcome. Good questions.
Just quick question about
Yeah.
I know you're looking for new deals.
Oh yeah.
Are you finding the biggest hurdle is more the properties are just not what you want, or is it more of a financial issue with what's going on lending, not lining up with what you want to do?
Yeah, it's actually the sellers. So what's happening, sellers are asking more than what their properties are worth. I call it the buyer-seller expectation gap. Sellers want more than what we can actually pay. And 6 months ago, it was really bad. I mean, they're trying to sell at a 3.5 cap and the interest rates were a 5.5. Like you can never do that. But they really, they're trying to come to grips with the fact that if they want to sell, their property isn't worth what they thought it was, because the reality of it is I have to get a loan at 5.5% and still have money left over for investors, right? So that means I can't pay a 3.5 cap. I just can't do that. So that expectation gap is really starting to come in a lot more than it was. And so the deal I'm looking at right now is probably one of the closest. I like the property. Our regional manager's driven the property. I can't say anything about where it is yet because I just don't want to do that. But it is in Florida. It is in a great location. I know the broker. It has a real possibility right now, and what's happening is the reason people that don't have to sell right now are probably not selling because they're just not. The people that are selling right now are the ones that have to sell or who are going to have to sell. And the reason they're going to have to sell is that whole rate cap thing. Their interest rates have gone up. Their rate cap is expiring and they don't have enough money to buy a new one. So they're distressed, not because of the property. They're distressed because of the financial. It's a finance thing that's stressing them. I mean, think about it. Rates went up from the SOFR rate. That's what I don't remember what SOFR is, but that's the rate, the index that we use on these bridge loans. It went from 0.08% a year ago, February, to over 4.5% in 1 year. I mean, how do you budget for that?
Right.
You can't. I mean, you can't. So they're guys that are in trouble. And so what we have to, at first they're like, okay, maybe I can find someone. This is what goes on in the psyche of somebody that is in that situation. And as they get closer and they start getting squeezed a little more, they start to get, okay, all right, I better come down with my pricing. I'm going to get down because I don't want to, if they wait too long, then the world's just going to say, guess what, pal, you're going to lose your building and then we'll buy it from the bank. So they're getting that stress is increasing in their body, and they're starting to become more reasonable with their selling price. So now it just becomes a battle with the buyers because we have a nice property. It's in a great area. The pricing is kind of reasonable. So now it becomes a preferred buyer situation. So now a bunch of syndicators are going to run to the table. I know they will. They always do. But then we're going to run to that table and say, guys, listen, we don't have to worry about raising money right now. We've already raised it. Gives us a massive advantage. Plus we happen to know the broker. Plus we've closed with the broker before. And everybody in these markets, they know us like the back of their hand. They know who we are and they know what it's like to deal with us. And, presumably it's a good experience. So that's what's really going on the ground with that situation.
Okay. Yeah. I mean, I'm just trying to weed out what I read and hear in the news versus what is really going on with these banks. If it's something that you are concerned about, are they tightening up lending? They're not giving out money anymore, or if it's, you don't see a problem with that going forward.
Yeah. Well, I mean, it could be an issue. If now think about this, play out what are some of the things I said about the banks. If they have all these unrealized losses sitting on their balance sheet from these securities that they're holding, and suddenly a bunch of office loans start to go bad, and a few multifamily people just hand in the keys because it's the way out of the deal because they're non-recourse. As banks start to get their capital starts to come under pressure, they will tighten their lending standards. They just will. That's very possible to happen. But again, it goes back to it's why we become a stronger buyer, because if the lender comes back to me and says, hey, Ken, I know I told you, and this is what really happens. I know I told you in the beginning I could give you 70% of the value, but you know what? We just came from loan committee, like it's 30 days after we started the process with them, that we can only go to 60%. This is what they do, and they do this on a regular basis. Well, that sinks a lot of syndicators because they raised X amount of money. We can be stronger. So that's why you be a disciplined buyer. If they tell me they're going to give me 70, I don't believe them. I go in and expecting to go to 60. Then they come back to 60. And yeah, of course I yell and scream, but it was probably what I thought I was going to get anyway. It's just the way we play this sort of game. So, does that make sense?
Yeah.
There's a lot going on here. I know there's a lot going on here. What matters is I want to be the strongest buyer I can be in a very high growth market. And I want to make sure that any deal that we go after, like, why would you not take our offer as long as it's reasonable?
Right.
That's my goal.
Okay.
That's a great question.
Yeah. one last thing, and I'll let you go.
Of
I had to
course.
think about what you just said there earlier about this, the federal funds with the standards, how they can now loan against, even though, they're behind in the treasuries? Did I hear you say that correctly?
Yeah, well, so what happens? Were you on the last call?
No, I wasn't.
Okay, so look, there's the replay. We'll make sure we get you the replay. It's on our YouTube channel too. Right, Max? It is, right? Yeah, Max says yeah. So when interest rates go up, the value of a bond, if you own that bond, the value
Yep.
of the bond goes down.
Right.
So we have banks that are holding billions of dollars in these securities that they paid in the case of SVB. I don't know what the gross amount was, but they needed to raise capital. They had to sell securities. They had to sell them at a $2 billion loss. And that $2 billion freaked out the market, all the people that had money in that bank. And they literally in 48 hours took all the money out of the bank and bankrupted the bank. That's
Right.
what happened there. Now, so what the Fed said is, look, we know that every single bank on the planet is holding these securities that they initially bought at low interest rates. Rates went up because Mr. Powell did that. And so the value of those securities are not what they used to be. So the Fed says, all right, we need to give these guys the ability to have access to this cash so that they don't have to sell their securities at a $2 billion loss and freak everybody out like SVB did. So they said, Mr. Banker, you can come to us. We will pretend like that security did not go down in value, and we'll loan you against that security as if it didn't go down in value. The Fed has the ability to do those kind of things
Yeah,
to make sure that they still have liquidity in the system. And that's what they did.
I gotcha. Yep.
I know
Okay.
that's complicated. That's pretty deep stuff, but
No,
that's what actually happened.
yeah. No, that was good. I got to read more into that.
Yeah, don't read too much into it because you'll get a
Yeah.
headache. Trust me.
No, I do. It definitely causes a headache.
Yeah,
And
no doubt.
you broke it down much easier for me.
I try. Well, thank you, sir.
All right. Thanks, Ken.
All right. Well, good talking to you again. Anybody else got questions? Wow, you guys have had some awesome questions. I really appreciate you. Hopefully, I always wrestle with going technical on these presentations. Do me a favor. Feel free to give me any feedback you like. If it's too technical, not technical enough, I really want to try to give you the real stuff, right? The stuff that the marketing guys won't do. That, this is meant to really help you understand what's really going on the ground. So hopefully I've achieved that goal. If you have interest in the fund, please reach out to Max or myself. Or if you just have questions, let one of us know. All right, guys. Thank you so much. It's been a pleasure. I hope that you got something out of it. I know I certainly did. Take care, guys.
Thank you.
Okay.